It's not particularly well known, but there are over 25 stock exchanges in existence on the African continent. They are represented in that map by the dark blue and then the kind of neon green, which we chose for some reason. Not all of these exchanges are well-functioning or particularly vibrant exchanges, but they are at least the beginnings of a stock market in these environments. If you think of the traditional notion of a market, which is what a stock exchange is, it's an environment where you bring together buyers and sellers. And a stock exchange is nothing more than an environment where a company that's looking to raise capital for purposes of growth and expansion comes to find people who are looking to invest in a growth story. The Johannesburg Stock Exchange, which was founded in 1887, grew out of the gold boom in South Africa at the time, and the mining and exploration companies that needed capital in order to engage in their business activities. Nothing more complicated than that. And that's increasingly what you're seeing in the rest of the continent. As companies are growing, as those economies are developing, more and more companies are looking for capital in order to realize their own growth story. So the question becomes, how do you, as in some instances, relatively small economy or marketplace, provide the kinds of capital that your companies need in order to grow? To a certain extent, you're constrained by the realities of the economy in which you operate. You have to service your local marketplace, and your local investors are likely to be the ones who will provide you with the capital. But increasingly, as we know, capital is global, and it flows across borders. So as an exchange, how do you ensure that you provide your companies with access to the greatest pool of capital to allow those companies to grow and expand in meaningful ways? Before doing that, before answering that question or providing the answer that we think works in our context, it's useful to look at the exchanges in sort of relationship to one another. Exchanges are by and large a game of scale. So you've got two things as an exchange. You can either offer a niche product that nobody else provides, which means you'll attract people in, or you provide so much variety that that's where people come to get what they want. This is a 3-axis graph, so you've got number of listed companies along the bottom, liquidity along the side, and the size of the bubble gives you the market capitalization of the companies listed on the exchanges. As you can see, the JSE still dominates the continent, but I think this is a reassuring indicator. We've gone from being about 90% of the market capitalization of the African continent about a decade ago to about 65% as of a calc I did last week. That varies from month to month, but by and large, the trend is real. What you can see, however, is that a lot of your other exchanges are clustered over the bottom end here. Relatively few number of listed companies, relatively low liquidity, and the market capitalization is still small. When you look at it in a global context, the picture looks even more interesting. And this is the picture you need to think about when you think about competing for global capital, because these are the options that investors or international investors have when they decide where to put their money. NYSE Group is an amalgamation of the New York Stock Exchange and a number of exchanges in Europe. The LSE Group is essentially the London Stock Exchange and Borsa Italiana, the Italian exchange. There was an attempt, which failed last week, to buy the Toronto Stock Exchange, but as I said, that's fallen by the wayside. Interestingly, if you look at the top 10 exchanges by market capitalization nowadays, 4 of those are Asian exchanges. So the Indian and the Chinese exchanges have started to move into the category of the largest exchanges in the world. Again, that tracks what one would expect from what's happening in those economies globally. On this picture, the JSE looks much less impressive than it did on the previous graph. And you can see the only other African exchange that still makes it onto this picture is the Egyptian Stock Exchange over there in the corner. Most of the other exchanges, when you plot it on this kind of graph, are too small to include in this graph as well. So a question of scale. You have to offer variety in order to get investors into your marketplaces. Most African exchanges are too small and too illiquid to attract much in the way of international capital investment. So how do you change that? we would suggest there are essentially 4 mechanisms on offer of increasing complexity, but increasing attractiveness to investors. At the moment, when an investor wants to access different African marketplaces, the way it has to do it is it has to set up different brokerage accounts or different investment relationships with each of the marketplaces in which it's investing. It usually has to set up technology to access each of those marketplaces. It has to understand different sets of rules and regulations. It has to receive data in different formats from each of those jurisdictions. And if you've only got 50 companies listed on that exchange, most of whom are relatively small, it may not be worth the investment in order to do that. One of the ways you can get around it, which actually the East African exchanges have done to a certain extent, is by harmonizing your regulation, your listings requirements, and your standards. So the investor in that instance, while they may still have to set up multiple trading relationships, at least the regulatory relationships that they need to provide or make provision for, the data that they take, the way in which the marketplace is regulated is much more standardized, and it's much more comfortable for them to invest in multiple markets. So, relatively straightforward, and a number of African exchanges have already started to move in that direction in order to try and make it more attractive for investors to come into their marketplace. An alternative or another mechanism is cross-listing. This is less in the control of the exchange, interestingly, and much more in the control of the company. We know that companies will often, what happens is they start in their home jurisdiction, they reach a certain size, and then they go list in another marketplace. So well-known examples in the South African context, South African breweries, Old Mutual, Investec, BHP, actually Billiton, all of whom have moved their listings to London, though retained a local listing. What that means is that South African and UK-based investors can easily access those companies and the shares in those companies. So what you can have is a situation where African companies can seek to cross-list across markets, and there are a number of South African companies, for example, who operate in other jurisdictions, who do cross-lists on other African exchanges, and it gives investors in those marketplaces easy access to those shares. And this is more about providing local investors with access to companies listed on local marketplaces. Then you go to a model which says technology is the enabler. And in many instances, technology can be the enabler. Most exchanges nowadays, many of them, even in Africa, have electronic trading environments. You no longer have a floor-based environment where the investor needs to be physically present on the floor in order to buy the shares. They have a trading screen on their desk, and they use that in order to send orders to the marketplace and execute orders. There's absolutely no reason, therefore, why you cannot, at an exchange, take that exchange and connect it to other exchanges on the continent. This is actually something that, as the JSE, in conjunction with the Committee of SADC Stock Exchanges, has been working on. How do you link exchanges electronically so that a trader sitting in South Africa can see not only the JSE on his trading screen, but also the Zimbabwean Stock Exchange, the Lusaka Stock Exchange, the Mozambican Exchange, and by simply tapping a key, enter an order into any one of the markets to which he wishes to connect. There are a number of regulatory and other considerations that you need to deal with in this instance, but from a technological point of view, this is an incredibly easy solution to arrive at. And then finally, the great nirvana, and I say great nirvana because it's possibly the most difficult to achieve, but in many ways the most logical outcome. Many of the economies which operate on the continent are realistically too small to run their own stock exchange. As I said, stock exchanges are games, are economies of scale games. They require large investments in technology, in regulatory infrastructure, in ongoing supervision, and all this sort of back office stuff which doesn't actually make money for the exchange. So one of the things that you can do to get economies of scale is say, instead of creating a Ugandan stock exchange, a Tanzanian stock exchange, a Nairobi stock exchange, create a single stock exchange that services the region. All companies then from that area would list on one marketplace, and everyone would access that single marketplace. There are obviously certain regulatory considerations with that. As soon as you start to do things across borders, you have then issues of currency conversion, exchange control, who is the actual regulator of the exchange, which jurisdiction is responsible for regulating the exchange ultimately. But in some senses, this is really the model that you want to get to because it achieves the most optimal outcome for investors in the jurisdiction and provides those jurisdictions with the largest pool, both of companies and investors, to access that marketplace, and makes it the most attractive for international investors. One of the things, interestingly, that we've seen, our experience has always been that we sort of had this sense that, at least in the African context, it was very much a case of what we call national airline syndrome. So nobody wanted to do this because, like everyone wants their own national airline, everyone wants their own stock exchange. And we thought this was peculiar to South Africa, Africa, developing markets. The recent exchange, merger and acquisition activity globally has shown us that this is not a peculiar to South Africa phenomenon. The Toronto deal was turned down because the Canadians felt quite strongly about having an exchange that was Canadian owned and run rather than being run by people out of the UK. There was another merger attempt in Singapore and Australia, which fell apart because people in Australia didn't want the exchange or the clearing infrastructure run by the Singapore exchange. So national airline syndrome or considerations apply in many jurisdictions beyond our own. So ultimately, just to repeat where I came from, the purpose of an exchange, though exchanges do many, many other things nowadays, the core purpose of exchange and the value that an exchange adds to an economy is by providing a marketplace where you bring together issuers and investors. As our CEO likes to say, if the exchange can no longer perform that function appropriately, then you should step out the way and allow somebody else to come in, because that's what an exchange needs to do, provide a marketplace for issuers and investors. What you want to do is provide that in the most effective and efficient manner, and you do that to a certain extent by building scale, by getting as many companies into one place as possible, and by getting as many investors looking at the companies that are listed there as possible, and by getting good coverage of those listed companies as well. That's where you guys come in. So by building appropriate scale and appropriate opportunities and leveraging technology, international standards, ideally some kind of regionalization, you manage to achieve that, we believe, in an efficient and effective manner.